Hi, everyone. Thank you so much for joining today. My name is Keeley Simpson, and I'm here to guide you through our second of three webinar in our Savvy Women Investor series. So today is taking control of your financial goals, and I'm here to guide you through with a focus on retirement planning, because today's session is for women that are aged 35 to 55. So thank you so much for joining us today and taking time out of your busy schedules. The presentation will be about an hour, and I'm happy to answer questions as I go along. You can put them in the chat, and I will see them, and I can try to answer them as we go through the slides, or at the end of the session. I also want to just to mention, I guess, a little bit of my own background. So my name is Keeley Simpson. I'm based in Toronto, Ontario. I am from Montreal, born and raised. And I did go to McGill University. I've been working at BMO Nesbitt Burns for 15 years. So somehow that makes me a senior wealth advisor now, which ages me a little bit, but that's okay. And then I'm also a portfolio manager, which means that I work with clients on a discretionary basis, and I am a full portfolio manager. I have a business partner named Lee, and we have two other people that work on our team with us and help us manage the clients that we work with. We have about 220 households that we work with right now. So I'll try to give some real live planning examples as well, so that you can hear a bit about that. And then just on the personal side, I am a mom of three little ones. My oldest is 4. He just turned 4. My second one is going to be turning 3 in a few weeks. And my youngest is 18 months old. And I'm also expecting my 4th baby right now. So if I sound like I'm getting out of breath, I apologize, but I'm due in a few weeks, and she's just pushing on my lungs now. So that's why. So we're running a very busy house over here, and things are very interesting. But anyway, I'll get to our presentation now. So I really love to start these presentations off with a quote: "Money is genderless, but investing for women is different." And what I mean by that is that generally, and that of course this is just a generalization, doesn't apply to everybody, but just generally what I've seen with my work over the years and lots of studies that have been conducted is that women tend to be, less confident in their knowledge about finances than men. And the uncertainty extends to retirement planning and financial products and services. So we know that knowledge leads to hands-on involvement in portfolio management in your own savings. And so that's why I like to do these seminars or webinars to help guide you through and give you, a couple of nuggets that you can take away and help make you feel a little bit more confident in the decisions that you're making on a day-to-day basis for your own personal financial situation. The other quote is, "Planning is bringing the future into the present so that we can do something about it now." And this is just a planning quote. This is just to show that if you have certain goals that you'd like to reach in your retirement or estate planning goals, any goals at all, that planning really is important for that. Planning ahead means that you will be secure in your retirement goal. So our agenda today, we are going to start with a quiz. So get a pen and paper ready, or maybe a note on your computer, whatever you prefer. We're going to talk about why investing for women is different. We're going to talk about some of the unique challenges that women face in planning for retirement. We're going to talk about the 9 biggest retirement mistakes and how to avoid them. We're going to talk also about the basic steps to building your net worth. I get a lot of questions about responsible investing, also cryptocurrencies. So we're going to talk about responsible investing. And then we're also going to talk about what to look for when you're selecting an advisor for yourself and for your family. So to start the quiz off, so right now, to maintain your current lifestyle after retirement, how much capital will you need to have saved? Do you know how much capital? What are going to be all of your sources of retirement income? Do you know what they will look like, how much they will be? How much income is each one of those sources of retirement income going to provide you with on a monthly basis? And what percentage of your gross income are you currently saving? And what percentage of that is on your net income? And what was the return on your investments or savings last year? Right now, this year, the markets are down quite a bit to start the year. So last year, the markets did actually really well, and we're up quite a bit. But this year, we're seeing a lot more volatility, and we're going to talk a little bit about that in our presentation as well, the current market conditions, but we'll get to that towards the end. So women tend to learn before they invest. As women, we tend to communicate differently than men do. And we obviously have different life experiences than men. And it also makes us a bit more risk averse. So we don't like to take on as much risk as men. And of course, these are just generalizations. It doesn't apply to everybody. It's just based on the studies that have been conducted that we have available to us. The other thing is that women do face unique challenges when it comes to planning for retirement, because it's typically presented as a couple experience. And actually, if you look at the statistics, more often than not, retirement for women is lived alone. Generally speaking, if you leave the workforce to take care of your kids, if you have kids, or take care of aging parents, then just generally speaking, you'll have accumulated a smaller nest egg than your counterpart. Women are living longer. I saw, I guess it was 2 weeks ago, that the oldest woman alive in Canada, she passed away at 114 years old in Quebec, nonetheless. So, you know, as women, we're living longer than men, just statistically, and now we're living even longer. So now when I do financial plans or retirement plans for clients, it used to be that you could use 90 or 95 as the age for the end of the plan. But now we're starting to use 100. And so if you retire at 60 and you're going to live to be 100, then you're looking at 40 years of retirement. So, you know, how do you reach that retirement goal if you're going to have such a long time period in it? And then obviously when it comes to retirement planning, we always tend to talk about finances, but it's not always about finances. There is a personal side to the retirement, to retirement, and women tend to come out ahead when it comes to that. And that's because women build relationships, and our identity is not necessarily tied to what we're doing for work. It's tied to family or to friends. So we tend to come out ahead. And then men and women tend to complement each other while in retirement. And maybe you're not going to feel that way if you're stuck at home with your husband. And you know, it's just a lot of togetherness. I don't know. But just generally speaking, it's, you know, men and women tend to complement each other in the retirement phase. So I do actually have a very handy tool. It's called the Retirement Expense Worksheet. And it's an Excel spreadsheet that can allow you to put in all of your monthly expenses that are outlined in the spreadsheet for you. And it can be, you can put them in as fixed or discretionary. And you can also then calculate what your future expenses will be based on when you want to retire. So if you would like the retirement expense worksheet, I am happy to share that with you. There's going to be a survey that goes out. If you would like to receive it, please just put it on the survey that you would like me to send it to you. and then I'll get that off to you. And then the other thing about the retirement expense worksheet, when it goes to be able to calculate the future expenses, you should be able to include inflation in that. And I don't know if you've seen as of late, or just going to the grocery store, it's costing more and more money to buy groceries. So inflation is a concern right now, and our inflation rates now are above 5%, which is the highest it's been historically for a very long time, since the 70s. So, you know, we can use 5% inflation. It just means that, you know, you'll have to have saved more to meet the retirement goals. So historically, it's been closer to 2 or 3%, and right now, what we're seeing is a 5% plus inflation in the U.S. It was closer to 8%. So that can really have an impact on your purchasing power, obviously. An apple today is not an apple tomorrow, so to speak. So just to keep that in mind. So what does retirement look like to you? Have you considered how the following may affect your retirement? So living longer, we've talked a little bit about. It's no longer a set point in time. It used to be that you would reach 60 or 65 and, you know, that was it. Now you can work longer, not work as long, it really depends. The sandwich generation is, you know, it's really important. It means that you're taking care of your children at the same time as your aging parents. This doesn't have to have as many financial implications as one would think, but it can have a lot of emotional implications and can put a lot of pressure on us as women. And, you know, also, you know, it can really have that that kind of implication. I'm being told that my slides are not changing. So just let me know if you can see things to consider. So I'm on the slide things to consider right now. So hopefully you guys can see that. If not, maybe I can press pause on the presenting to allow you guys to see it. So it'll just take 1 second. Sorry, we're having some technical difficulties. Okay. So can you guys see my slide, things to consider now? Women now taking care of their parents. Women may leave the workforce for a longer period of time to take care of their children. Adult children returning home. Caring for grandchildren so their parents can work. Outliving your spouse. And then I have divorce question mark. And then working longer, how much and in what capacity? So now I'm on, I just want to make sure that the slides are working. Now I'm on traditional rules of thumb and retirement myths. So when we're planning for retirement for clients, I hear, you know, clients sometimes say, oh, I'm going to be fine. I have a company pension plan, which is very good. Don't get me wrong, but there are other factors to consider. I'm being told that you guys can see the slides now, so hopefully that was just a small glitch in the presentation. Thank you all for your patience while we worked through that. I'm going to need to have 70 to 80% of my pre-retirement income. I've heard that I need to save $1 million. Well, I think you may actually need to save more than that now, just based on, you know, inflation and things like that. I'm going to be fine if I only withdraw 4 or 5% a year from my savings to retire. The 4 or 5% rule is a good rule to use as long as your portfolio is earning more than inflation, you know, and it, you know, then it will last you for a longer period of time. Just that now with inflation being at such a high number, it means that you would need to have, you know, like a 10% return on your savings in order for that to be true. And again, we'll talk about this during the presentation. So how to avoid the 9 biggest retirement planning mistakes. So I thought I would give a couple of scenarios for you guys to think about today. What I like to do with clients is build out a worst case scenario. So pretend like the world is going to fall apart 10 years before retirement and there's a 25% market crash. Are you still going to be okay? Have you saved enough? Just like to do that because you know, things don't always work out the way that we plan. And if, you know, remember 2008, if we remember even just a couple of years ago when the pandemic started, you know, the market can crash. It does obviously come back over time, but just generally speaking, it's good to have a worst case scenario plan. We want to make sure that your nest egg, so to speak, lasts 30 plus years because of how long we're living now. We really need to account for inflation. And I know I've said inflation probably 10 times in this presentation already, but it's really important because it can impact your purchasing power. How and when to maximize government benefits. So in Quebec, it's the Quebec Pension Plan, and in Ontario, the Canada Pension Plan, and other provinces, Canada Pension Plan. So when should you be taking your CPP or your QPP? We want to make sure that you're always minimizing and reducing your taxes, because taxes mean that you have less money to invest. And so we want to make sure that we're really taking that into consideration, both leading up to and during retirement. So you want to build a really efficient investment portfolio when it comes to that. You want to also make sure that you're reducing your fees along the way, minimizing your costs so that you can keep more of the savings in your pocket, right? You worked really hard to earn your money. You know, you want to make sure that you're getting, you know, the best possible, you know, keeping more of your savings, right? You also, in my opinion, want to work with someone, an advisor who is a fiduciary. That may seem biased of me because I'm a fiduciary, but you know, there's actually not that many advisors in Canada that have the fiduciary duty to clients, because it's a special license that you need to be able to get. You need to be working in the industry for over 10 years. You need to pass certain courses. You need to become a chartered investment manager. There's a lot involved in the background. And a fiduciary is someone who has their client's best interest in mind, but not just in their mind, from a legal perspective too. So I think that this is important. You don't want to be missing out on the growth and upside in the equity and fixed income markets. We want to make sure that we're always trying to maximize our returns and get those bottom line results for you. You want to make sure that you're protecting and preserving your portfolio. So as I mentioned before, you know, you can have a 20-25% market correction. You know, what happens if that happens right before you need to start drawing down on your portfolio for retirement? The timing of it, of course. So those are sort of some of the my little aha moments, or you know, nuggets that I've learned along the way. I think it's really important that you have a plan, basically, and that you're working with someone that you can trust, and that they have your best interest always first. So I do have a checklist. So it says checklist 10 years to retirement. If this is something that you would like, please please request it along with the budgeting spreadsheet if you'd like, and I can send it to you. It comes with a checklist, so that might be helpful to you. There's also a checklist that's 2 to 10 years to retirement. In case you're closer to retirement than I would think from the viewing perspective. I just thought I would include that for you. So obviously, if you're closer to retirement, then you want to make savings a priority. You really want to make sure that you have your retirement picture lined up, and you want to make sure that you've got a handle on your current and future expenses. So let's develop our retirement plan today, just so that you guys can put something down on paper and see where you're at. So the first step is that you want to have a plan. Okay, and so why don't you write this down? Why don't you create your balance sheet and see where things stand? So how much do you spend and how much is left over? So you know, basically what your monthly income would be, how much you're spending, how much is left over. You want to create a statement of net worth. So whatever assets you own minus the liabilities. So an example of that would be if you own a house or a condo or any other property. So asset is what you own minus the liability is what you owe, so your mortgage, and that gives you a net number. The net is your net worth, and then you can determine what your net number is. You can also add in any financial assets you have, anything like that. And then I think the important thing here is that you want to pay yourself first. So how much can you save? And really, I think the other question is how much should you be saving to reach your retirement goal? So paying yourself first means having a budget. So that expense worksheet that I mentioned before can outline how much you're spending and where. And you know, hopefully that should help, you know, that should help you create a budget. You want to make sure that you have an emergency fund in case something were to happen with work. To have it as a nice cushion, you know, you want to have at least 3 months of net income saved up. You want to be saving within a tax-free savings account and or a retirement savings plan, which we're going to talk a little bit about. And you want to have a reinvestment program. So if you're going to be investing in RSPs or a Tfsa or any other account types, make sure that if you're buying stocks, then you have the dividend reinvestment program on there. It helps you accumulate and compound your earnings faster than if you didn't. So first, the next thing is that you want to set your objectives. So, you know, maybe there's a major purchase, maybe retirement is your goal. Based on today's age group, I would think retirement would be the primary goal here. Perhaps it's even children's education, RESPs, maybe it's estate planning. You know, do you have proceeds of insurance and gift planning? I've been talking a lot about gift planning lately with clients, and it's a really interesting conversation to have. And I think that it's something that is going to be more and more popular in the years to come. So you want to develop your retirement plan. So these are the 3 sources of retirement income. If you have a company pension plan, that would be one of them. Government plans, so QPP or CPP and old age security. And then your personal savings, RRSP and Tfsa. And also, if anybody has any questions, please feel free to put them in the chat and I can try and answer them as I go through the presentation for you. So replacing today's income. This is based on a 5% inflation rate. Oh, I think I've said inflation now 12 times. So basically your income today, let's say your income today was $60,000 a year. 10 years later, it would mean that you were earning $98,000 a year. 20 years later would be 159. 30 would be 259. 40 is too long to look at, but 422,000 a year. So when we say inflation is so important, it's because it's all about replacing today's income. And as that income number grows to be a bigger number to get replaced, it means that more needs to go into the savings. So let's talk about an RSP, which is a retirement savings plan. You have tax deductible contributions and tax deferred compounding. Starting now is better than nothing. These are some of my rules to live by. So you want to open a retirement savings plan. You want to contribute your maximum if it makes sense from a tax planning perspective. You want to contribute early each year or on a monthly basis. I try to encourage my clients to contribute on a monthly basis if it makes sense for them, just so that they don't have to worry about it and make a big lump sum contribution by the end of the year. And you want to invest wisely. There's something called the 2% difference that I'll show you next. So, let's say you have a 6% a year portfolio, like a portfolio that's earning 6% is your rate of return versus 8% or 10%. This assumes that you've put in $5,000 a year for 5 years, and at a rate of 6%, that portfolio has now grown to $29,877 in year 5. At 8%, it's grown to $31,680. And at 10%, it's grown to $33,575. But let's fast forward a few years. Let's say we look at year 25. At 6%, it's $290,000. At 8%, it's $394,000. So, more than $100,000 more. And at 10%, it's $540,000. So that's a big, wide difference. 35 years, $590,000 at 6% rate of return. 8%, your portfolio value would be $930,000, and at 10%, it would be $1,490,000. This can obviously be a big difference maker. So the tax-free savings account was introduced in 2008 by the federal government. I think it was maybe misnamed. It really should be called the tax-free investment account, because that's really where you get the biggest bang for your buck. Some people use it as a separate savings account and, like in and out movements. It's really meant to be a place where you have money invested for the long term and it grow tax-free. So you're allowed to contribute a maximum of $6,000 per year in the past few years. There are other times that you were allowed to do 10 or 5,000 or 5,500, but basically the government kept the limit the same for 2022. Your investments will grow tax-free within the tax-free savings account. So any interest you earn, any dividends, any capital gains will grow tax-free. If you've never opened one before and you were 18 before 2009, then you can contribute $81,500 today. Some of the rules are: do not over contribute and do not contribute, withdraw, and contribute again in the same year. I have some questions that are coming through. So these are very good questions. I think I will save these ones until the end, just because they aren't questions about the slide specifically. They're questions that are general questions. So I'll get to these in a few minutes. I see them and I will get to them shortly. But please feel free to continue sending in your questions as they come along. So the tax-free savings account versus the RSP. So with an RSP, when you contribute to an RSP, you get a tax deduction from the government, thereby making your overall taxable income for the year lower. When you contribute to a tax-free savings account, you don't get, there's no tax credit. It just grows tax-free for you. So basically over here, if you contributed $5,500 to both a Tfsa and an RSP, and your marginal tax rate was 40% when it was contributed and 40% when it was withdrawn, then you'd be the same net. Your net withdrawal would be the same. Now let's say your marginal tax rate was 40% when you contributed and 20% when you withdraw, then obviously the RSP has a bigger balance, right? Because it's giving you more in your pocket. And the opposite is true. If you have a 20% marginal tax rate when you contributed and 40% when withdrawn, because it doesn't have the same tax benefit. So working longer, legacy decisions. So if you had a portfolio that was earning 6% a year, and you were going to withdraw $18,000, then how long would $250,000 last you? It would last you 18 years if you retired today, and it would last you an extra 5 years if you waited for 2 years. So I think the point is that you want to have a retirement plan in place to see when the optimal time to retire is. So you want to create and manage a good investment program. I did see some questions about some investments before, so I think I'll answer them in the next couple of slides here. So what is your current financial picture? What is your risk tolerance? Can you handle a lot of volatility? What's your time horizon? So how long do you have to invest? What's your knowledge? What kind of time commitment do you want to put towards, your investment program? And what are your goals? So the investment menu is short-term means it's invested for less than a year. Fixed income is bonds or preferred shares, and then stocks is common equity. So one of the questions that came in before was, I invest myself mostly through ETFs, about 60% stocks and 40% bonds. I have used a bond ETF with a mix of short, medium, and long-term bonds so far, but recently bought a short-term bond ETF thinking that this would be better to cope with inflation. What are your thoughts on short-term versus long-term ETFs in today's context? So this is a great question because bonds, just going to skip through to the bonds over here. So this person is asking about bond ETFs, so exchange traded funds that basically follow the bond index. And this person has switched to shorter term bond exchange traded fund exposure versus long term because of inflation. So it really comes down to whether you think interest rates are going to go up in the near future or they're going to stay the same. So the Bank of Canada today held rates instead of raising them when everybody thought they were going to raise them today. What this means is that bonds and interest rates have an inverse relationship. So based on the fact that we're probably going to enter a rising rate environment, you probably do want to have shorter term bond exposure, like bonds that are going to come to maturity in less than 3 years. You could go up to 5 years, but they're just going to be more volatile. But then inflation means that you're not going to be getting a 5% return with short-term bonds. So I think you probably want to balance the two. And you just need to take a long-term approach to know that over time things will stabilize with the bond market, with interest rates. And if you want to have a higher rate of return to keep up pace with inflation, then you need to invest in longer-term bonds because they will provide you with a higher rate of return. If you want to protect the principal in your portfolio, then you want to invest in shorter term bonds because we know that rates are going to go up. And well, we know that they're supposed to go up sometime this year. Everybody thought it was today, but nope. So I think you want to have a balance between the two. And I think you just want to be aware that, if interest rates go up, then your bond prices are going to come down in the shorter term, and eventually things will stabilize. With bonds, they pay interest payments. Those interest payments are guaranteed. With bond ETFs, exchange traded funds, it's based on an average yield. So that should be pretty stable. You want to make sure that you have a balance between the two. So the other part of fixed income market is preferred shares. Preferred shares do offer you regular dividends. They also come with a credit rating like bonds do, and the prices should be less volatile historically. I did have a situation a couple of years ago and back in 2008 with interest rates changing as much as they did. Preferred shares really fell apart. They went down by over 25% in both cases because interest rates went down. This was unexpected. The preferred shares are part of people's or part of your fixed income portfolio. That's not something that's expected to happen in a fixed income portfolio. You invest in preferred shares so that you can have more stability, right? So just historically, they tend to be less volatile, but when there is uncertainty about interest rates, they can be more volatile than one may or may not like. Common stock is basically anything that's publicly traded on the stock market. So you have ownership in the company like BMO, RBC, TD, GE, Ford, any of those companies. Most companies, well, not most, but I don't know what the percentage is, but will pay you a dividend as a shareholder. And if you invest in companies that are outside of an RSP or a tax-free savings account, you can get a dividend tax credit for that. And then you should have some capital appreciation potential. Asset mix is basically a strategic blend of stocks, bonds, and cash. It's based on what your risk tolerance is. Why is it important? It's important because it has a strong influence on the risk-reward trade-off that you're going to experience in your portfolio. It is the most effective method of accommodating those unique investment preferences. So, you know, if you want to earn 6% a year, then you may need to have more invested in stocks than bonds. If you're someone who can't handle the volatility, then you may need to have more invested in bonds, and your trade-off is having a lower rate of return. This is a graph of the US and Canadian stock markets over the last 5 years. So as you can see, there's been a lot of growth, but obviously in 2020, we experienced a very big dip, a 35% crash, and it did recover. And last year, it did really, really well. This year, we're seeing a 15% plus correction so far with the technology sector, which has really impacted the Dow Jones. Not so much the TSX and the S&P 500. Those are down as well, but actually the TSX isn't down as much. But you know, this year we're having a start to the year that's much more volatile than last year. So the important thing is to take a long-term approach when it comes to investing in the stock market. Diversification reduces risk. So if you have 30 names in your portfolio, that's probably the optimal number. Beyond that, well, 40 names is fine too, but beyond that, you probably are not going to have a higher rate of return than the market because you'll have too many securities. But you know, between 20, 30, 35 names in a portfolio is probably what you want to aim for. Diversification is achieved by asset type, so whether it's stocks or bonds or cash, by industry, so financial, healthcare, energy, by country, Canada, US, international. These are some of the current market conditions that we're experiencing right now. And I'm just going to answer some of these questions that have come up. So what is gift planning? So gift planning it's basically planning to give some of your money away to a charity. So that can be done by donating appreciated securities. An appreciated security is one that you bought for $1 and it's trading at $10 today, and it's outside of your RSP or your Tfsa. And if you were to sell it, then you would experience a taxable gain. But if you were to donate it to a charity, then you would get that as a tax credit. So it's a very efficient way of achieving that. If you want more information on gift planning, I'm happy to provide that to you. Just let me know. You can send me an email or reach out to me on LinkedIn, whatever you prefer. Should we rely on the CPP in 10 or 15 years? I really hope so. I don't see it going bust. We do contribute to it every month or every time we have our paychecks, right? So they are getting money in as they get money out, and their returns are stable. So I think we should be able to rely on it in 10 or 15 years from now. What percentage of inflation is the replacing today's income forecast based on? It's based on the fact that inflation is above 5% right now, and that historically inflation has been at 2 to 3%. That's based on the CPI, the Consumer Price Index. I find that the CPI always dumbs down what the actual inflation rate is, because if you go to the grocery store and you try and buy chicken or bread or anything, all of the prices have increased. That doesn't necessarily get factored in, I think, as closely for the CPI. A really silly example is there are these treats that my 2 dogs love at Pet Value. I've been buying them for years. They have always been $3.49. They are now $4.45 out of nowhere. A full almost dollar increase per treat. And it's like a 12-inch treat. I mean, so I think inflation is, the percentage of the inflation number is based on what we're seeing right now. And it's also based on the fact that the CPI historically just always dumbs down what we're actually spending money on. So that's why I have 5% in this presentation. What do I think about RRSPs? We have a baby and we are perplexed. What are the difference between the options that banks offer versus some other private institutions? I think RRSPs are a great way of saving for your baby's future education needs. When you contribute money to an RRSP, you get the Canada Education Savings Grant in the plan. There is an optimal number to contribute. It's about $2,500 a year to get $500, which is the maximum grant from the Canada Education Savings Plan. So I think the banks offer this, private institutions offer these options. I think that they're all good options. Okay, so let's get back to my technology correction redux. So if you would like this report on the current market conditions that we're experiencing right now, please let me know in that survey. Let me know if you want the retirement expense worksheet, any of the checklists, or this current market conditions report. I'm happy to send them along to you. Basically, what this report highlights is the impact of inflation and interest rates. I guess now I've probably said inflation 20 times. Higher inflation erodes purchasing power and pushes interest rates higher because central banks are forced to tighten monetary conditions to prevent inflation from spiraling out of control, as we witnessed in the 1970s. This is exactly what we are experiencing right now. This is why the markets have been so volatile to start the year. And I think that this is going to be a theme that we're going to see this year. The other thing that the other topic I get a lot of questions on is what is responsible investing. So responsible investments are ones that align with your values. They have proper risk management in place at the company. They follow sustainability opportunities, so to make it sustainable. And they have active ownership. So they're engaged with voting when it comes to sustainable investing. We also have a global sustainable investing portfolio available to clients, where the stocks or the companies that we're investing in are selected as an equally weighted portfolio. It's comprised of 20 different names that are selected for you, and they're all companies that rank really high on the benchmark for the portfolio, which is the MSCI World SRI Index, which is the Socially Responsible Investing Index. All of these companies are ranked using the same guidelines, and they're all companies that you can feel good about investing in, or hopefully feel good about investing in, if that's something that's important to you. So when is the right time to invest? Look, with the markets down right now, one might be tempted to, go with all of their cash in right now. It really depends. There's risks of market timing. You can miss upswings. You can create yourself some capital gains. I think you just want to take a long-term perspective. You want to buy value. You want to buy dividend-paying companies. I think that's important so that you can get paid while you wait. And I think you just need to take a long-term perspective. And in times that are, volatile like we're seeing today, I think, you want to average in, so to speak. Like you don't want to just pick one day and just go all in. I think you just want to average in and take your time, take that long-term perspective, and maybe even wait for things to shake out a bit. So tax considerations, dividends obviously are more tax effective than interest. You want to pay off non-investment related loans, and you want to defer the taxable capital gains if you invest in a non-registered portfolio. So if you have any more questions, please send them in. We have 15 minutes left to our presentation. I'm just going to go over what selecting an advisor looks like, and then I'm going to get to the rest of the questions that we have here. So selecting an advisor. So, maybe you want to ask for recommendations from friends or family members. You want to conduct some interviews with different advisors to see who you feel is the right fit for you and your family. You probably want to speak to that person a few times, get a review of your current portfolio, like a second opinion of what you're doing right now, and get recommendations as to how they would help you with the portfolio. And also, I think what you want to do is you want to understand how they get paid. So do they charge a management fee, or are they a commission-based advisor? If you work with an advisor at a big brokerage, so BMO, RBC, DS, TD Private Wealth, any of those, then the services that are provided by your advisor are financial and retirement planning. They're going to help you with setting your goals and your objectives. They will provide you with investment research and advice. They will help you manage your financial assets. They will give you progress reports, so monthly statements, financial updates and portfolio reviews. So you can decide from a service level expectation what works best for you. If you want to, talk to your advisor on a quarterly basis, biannually, once a year, depends on what works best for you and your family. So that's my presentation for today. So I can be reached at 416-928-3323 or keeley.simpson@nbpcd.com. I will keep going through your questions here. So in times when we are not earning a lot in a given year, mat leave or sabbatical or job change, is it better to withdraw from your Tfsa or your Rrsp? Well, it really depends what your tax bracket was when you contributed to your Rrsp. If you're not going to be working, then drawing funds from your Rrsp could make a lot of sense because, you're not going to be taxed a lot on it. But I think if you have money available in your tax-free savings account for that, that would be a better place to go, just because then you don't have to have any taxable income for that year. Can I explain the rules on my slide? I missed that one, so I'm sorry, I don't know which one that was. Happy to talk more about it. You can send me an email or let me know which slide you were referring to. I'm sorry. If we didn't put money in our TFSA account in 2021, can we put 6,000 times 2 for the 2 years in 22? Yes, you can. And you can also check with CRA what your lifetime limit is by calling the TIPS number. What is a marginal tax rate? Well, that's the rate at which you're taxed from an income perspective. So whatever T4 income you have or income on investments, the marginal rate is the average rate at which you're taxed. You can actually see that on your last tax return. If you go on CRA and you look at your last tax return, you can see the blended rate from there. Okay. So a few more questions coming in. I had my dad invest money into stocks for me, and I lost a good amount of money. With the remaining money I have left, should I just cut my losses and use that money to invest it more wisely or leave it in? I'm afraid I'll keep losing. That's a really tough to say. It depends if you think that the companies that you bought are going to come back, so to speak. Have you looked at any of the analyst research on these companies that were purchased for you? Have you looked at their business models? Have you looked at their earnings per share? Do they pay you while you wait? Like, do they pay you dividends? I'm not really sure what to say to that, just because it could make sense to cut your losses. It could also make sense to wait. Just depends on what the prospects for these businesses that your dad invested in for you. Happy to have more of a conversation about that if you'd like. Just give me a call or send me an email and we can talk more about it. It's just hard to say based on, you know, if it's ABC Mining Corporation, then I don't know if they have any mines, like if they're going to find any gold or anything like that, or if it's an energy company, then, you know, energy is doing better this year, so maybe it'll come back. If it's a technology company, well, right now we're seeing a lot of pressure on it, so maybe it makes sense to wait. It just really depends what those companies are. I don't know much about all of these different types of investment possibilities. How can I learn more after this webinar? I guess just let me know what kind of information you're looking for. We have lots of resources available. We can send you a list of books to read. There's Investopedia for investors, which is really helpful when it comes to learning the terms that I talked about in this presentation, like exchange traded funds, things like that. So I think that should help. Is it better to fund a TFSA from my annual income or to transfer shares from an unregistered account? How to minimize taxes paid? If you've got the available cash flow for your TFSA, then I would do it from your annual income. If you transfer the shares from an unregistered account, then you may be taking a taxable capital gain, which you may or may not want to do. I always recommend to take money from your savings account or from your annual income to maximize the TFSA if you can. It's also important never to transfer shares from an unregistered account to a registered account. If there's a loss on the shares, you don't get the loss credit for tax purposes. It's better to sell them, get the loss, and then you know, from there move the cash in. Gold is a great investment for a portion of your portfolio, especially when it comes to protecting your portfolio when inflation is a concern. How do we choose a financial advisor? So I think I talked a little bit more about that before, where I talked about getting recommendations from friends or family members, conducting interviews, and just seeing if the person is an overall fit for you. I started working at BMO Nesbitt Burns 15 years ago. And it honestly only started because my mom had such a terrible experience with her advisor. She ended up getting very sick out of nowhere. She was running a very successful business as a business owner, and out of nowhere just became debilitated. Basically, she had to have 6 brain surgeries. She has what's called trigeminal neuralgia now, which is a very rare facial pain condition. But basically, she couldn't sell her business because she was the person who was doing the sales for the business, so there was nothing really to sell. And she was earning a high income, and she could have afforded disability insurance, but unfortunately, the advisor that she was working with didn't make that recommendation for her and didn't do the proper planning for a business owner. So I saw that and I thought to myself, well, there has to be a better way. And so that's why I started in this business. I wanted to help specifically women and help business owners make sure that they have the right plan in place, and all clients really have the right plan in place, planning for that worst case scenario, making sure that you're covered in all aspects. If you're not working with a company that offers you disability insurance, it's important to have disability insurance that you can, count on if you were going to become disabled, because there's apparently, based on statistics, you're 4 or 5 times more likely to become disabled than die within a certain age range. And we're always talking about life insurance instead of disability insurance. So I think when you're looking for a financial advisor, you want to make sure that they're going to have your best interests, and you want to make sure that you're working with someone that you can trust. Can I explain the CPP clawback, and will it be there till age 95? The CPP does not get clawed back. It's the old age security, and yes, it will be there until age 95. It's based on your income in retirement. So if you have an income of more than, I think last year it was 75,000 some dollar, then you will not be eligible to receive as much as the monthly old age security would give you. It's a social security payment, so it's really there for people who don't have a high income in retirement and depend on it. And it's not, it's not something that we're contributing to except for our taxes. Whereas the CPP is based on what you contribute into the plan and what you're eligible for when you go to retire. Is investing with Questrade or Wealthsimple do-it-yourself online safe? It is safe. It should be safe. And I think that they offer great tools for do-it-yourself investors. And they also offer good risk management profiles for you to figure out if you have the right risk in your portfolio. So we just have 2 minutes left. So I'll just see. So it looks like we've got lots of other questions here. Maybe I'll just answer 1 or 2 more just so we're still on time. Prior question about a previous slide, rules on the slide for investing in a Tfsa, there were 2 rules. Yes, there were 2 rules, and it's don't over contribute to your tax-free savings account. So don't contribute more than you're allowed to based on your allowable contribution room, which would be available through CRA. And don't contribute, withdraw, and then contribute again in the same year more than what your allowable room is, because you can have penalties. The CRA will charge you a penalty if you over contribute to the plan, and it's a 5% penalty, and you have to pay that unless you can make a case as to why you over contributed without being able to show why. So hopefully that answers that question. Could I please clarify whether dividends paid out into an RSP from investments made in the US funds are subject to tax? Thank you. Yes, they are. So no, the money will grow tax-free. But if you invest in a US stock in your RSP, then that US stock will have what's called the non-residence tax applied, and that will be reduced from the amount that you receive when you receive your dividend from the US company. So it's 1:30. I'll just do one more question here. If I didn't get to your question, please feel free to email me. I'm happy to take it offline as well. So I'm in the USA and have a 15-year fixed rate mortgage at a low rate. In this high inflation environment, is it better to use extra cash to pay down the mortgage or let inflation decrease the actual value of the amount owed on the mortgage? I think if you have a low rate on your mortgage, I don't think there's a huge rush to pay it off, to be honest. I mean, I guess if you've got a variable rate, then you want to look at how much your rate is going to increase to once rates do go higher. Maybe that's something that you want to talk to your mortgage broker about and just see what your options are. I think having a balanced approach to paying off your mortgage and investing in your portfolio is really the best thing that you can do. And if inflation is a concern to you, then I wouldn't be buying bonds with that extra cash. I would be looking at buying some good stocks with it and just doing a balanced approach between the two. So again, thank you all for attending today. I hope you found it useful and informative. Again, my name is Keeley. I can be reached at 416-928-3323 or keeley.simpson@nbpcd.com. Please feel free to fill out the survey monkey that will come directly to me, and I can follow up with you directly that way if I didn't answer your question or if you wanted any material that I touched upon during this presentation. So I know I covered a lot, and I'm sorry for saying inflation so many times, but it's a sign of the times, and I hope that you enjoyed it. Thanks a lot, and have a great day, everyone. Bye.